All right, guys, bang, bang. I'm here with Will. Will, let's just jump right into it. Reflexivity Research, they published a Q2 report, similar to like a public market report for a public company, but for the Bitcoin network. The first chart that you guys have is the price drawdown since all-time high. What's this showing us?
Yeah, for sure. So essentially what you're looking at is just in red. The further down that the red line goes, the more prices draw down from its prior all-time high. And so as you can see, Bitcoin drew down as much as 75% towards the back half of last year, but is now down on a relative basis only 55% from its all-time high. Bitcoin's had a massive year thus far, up 85% relative to gold being up 5%, and even over double the performance of the NASDAQ, which has been on a record run this year, which is up about 40% year to date as well.
So the next one that you have is the price performance since the cycle low. What is that showing us?
Yeah, so we included a couple charts to just look at kind of the current cycle relative to previous market cycles for BTC. We have two charts that I guess we can switch back and forth with and show. The first is Bitcoin's price performance from its prior cycle lows, and the second is Bitcoin's price performance since its prior cycle high. And so what this is showing is essentially, while history doesn't always repeat, it often rhymes, and we can see that this current cycle is mirroring similar to price action to the couple other cycles that are shown here, color-coded on the charts.
And when we see past cycles, obviously the kind of 2010 to 2013 cycle, that was like kind of the most explosive one. Should we expect to have less and less explosiveness to these moves over time as the holder base gets larger and more diversified?
Yeah, I think it's a pretty fair assumption to make that you'll likely see diminishing returns from like a cycle to cycle basis as the market continues to mature and becomes a larger asset class, because you just need more capital to be able to move it, in that order of magnitude of price growth.
Now let's talk about Bitcoin's market cap dominance. We've seen that it dropped significantly during the bull market, but it has come roaring back, sitting now, I think, over 50%. Why is that such an important metric?
Yeah, so we kind of structured off this one part of the report into essentially looking at market structure. And the first thing that we mentioned is what you just described, which is this Bitcoin market cap dominance chart. So you're essentially looking at Bitcoin's market capitalization relative to the market capitalization of all the other crypto assets in the market. And what we can see is that Bitcoin's market dominance is now over 51%. This is the highest that it's been since, I think, April of 2021. So, over 2 years now of Bitcoin dominance that we've seen kind of reclaimed over these last couple of weeks. And I think a big part of that has been we've had two kind of idiosyncratic news events that have benefited Bitcoin, at least on a relative basis to the other two crypto, relative to the other crypto assets. The first one is the SVB collapse and kind of banking crisis that we saw in March of earlier this year. And then the second one is this BlackRock ETF filing and other ETF filings that we've seen following the BlackRock one. And so that's uniquely benefited Bitcoin relative to the other crypto assets. And so I think that's driven a lot of flows into BTC relative to those other assets.
So I think that's like an opinion you have, but you also can then go look at the perpetual volumes. And it seems that there's a divergence there between Bitcoin and Ethereum as well.
Yeah, so when we look at what's here on the screen, which is essentially just looking at the Bitcoin perpetual swap volume, which is the most liquid product that's traded in crypto on a relative basis to Ethereum's perpetual futures volume, we can see that there's been this divergence, as you described, over kind of the last month or two, especially after the BlackRock filing. And what that means is that there's more kind of speculative interest and people looking to kind of wager bets on Bitcoin relative to Ethereum.
Now, when we look at different markets around the world, one of the things that you've taught me that I find just absolutely fascinating is in recent weeks, the US has had a premium in trading hours compared to all other markets. Explain this a little bit more.
Yeah, so I think, even outside of that, we can see that the ETF trade has been kind of in full effect across several different things. But who's been primarily putting that trade on? It appears that it is US-based entities that you just alluded to. There's two things that I kind of look at as evidence of that. The first is what's called the cumulative return by session that we can look at from Velo data here on the screen. We have it broken down into the EU, APAC, and then US trading sessions. And so what we can see is that, especially again since the BlackRock filing, but even slightly beforehand, we could see that the US has been more actively bidding BTC relative to those other trading sessions. And then as another piece of evidence that we can look at to see that there's kind of US-based firms getting involved in BTC recently, we can look at the Coinbase exchange trading volume, the Coinbase price premium relative to the other exchanges. This means that Bitcoin has been trading marginally higher on Coinbase relative to the other crypto venues. And then the last piece of evidence as well is looking at CME futures open interest. So this just looks at the total number of futures contracts outstanding on the CME who usually trades on the CME. It's not kind of crypto degenerates that are looking to punt on leverage. It's kind of US-based traditional type firms. And we can see a clear jump in CME futures open interest following the BlackRock ETF. About $1 billion of open interest was added in that time period.
Speaking of ETFs, I think that now we're starting to see Grayscale's kind of discount to NAV tighten a little bit. And so it's getting a little bit more attractive for investors, but obviously still a pretty big, deep discount. How do you read into that?
Yeah, so I think, again, this is evidence of kind of the ETF trade being put on. As you mentioned, we're looking at here in the chart. On the top portion is just the price of GBTC. On the bottom, we're looking at the discounted premium to NAV, so or net asset value. So how closely, essentially, is the trust tracking the underlying Bitcoin that it's supposed to be giving investors exposure to? And what we can see is that discount has come down from roughly 50% down to about 30%. So this is the kind of lowest that the discount has been in over a year. What does that indicate? It shows that it's more closely kind of tracking that underlying net asset value of the price of Bitcoin. And I believe that it's the market starting to price in the idea that there could potentially be a bunch of ETFs approved, including Grayscale's, as they are actively, undergoing a lawsuit against the SEC to get their ETF approved.
That makes sense. Now, one of the things that you have here is looking at the liquidity in Bitcoin's market, and you specifically look at coin-denominated kind of bids and asks in the order books. This is getting a little bit more technical, so explain a little bit kind of how this works, and then why is it so muted in your opinion?
Yeah, sure. So I think we should maybe start with why is liquidity important in markets? Liquidity is important because it gives the ability for large buyers and sellers to transact within a market and even get involved. So, you could have someone that was maybe interested in purchasing Bitcoin that managed a multi-billion-dollar hedge fund when it was $1 million market cap, but they just couldn't remotely get any amount of size that's relevant to them. And so therefore they had to wait until the market became more liquid. So there's a very kind of tight correlation with the ability for institutions to get active in the market and the amount of liquidity that's in the market. And so what we can see here on the chart, as you described, is the coin denominated. What we have showing is the 2% market depth. So essentially, what's the amount of BTC in the order book between the current trading price and what would move the price up and down 2%, essentially as a proxy for how much liquidity there is in the Bitcoin market. We can see that that's continued to decline over the last year, despite the positive price appreciation that we've seen throughout the year. And that's a reflection of, the kind of counterparty risk that we've seen throughout the entire crypto space, with all the different exchanges and different venues and lenders blowing up throughout the entire space, as well as market makers. And then also kind of the regulatory uncertainty that we've seen in crypto that's kind of plagued at least, US-based crypto firms and provided a ton of, regulatory uncertainty for those firms over the last year or so. And so what does this all mean? It just means that larger buys and sells are going to have a larger impact on the market overall, and we're likely to see more volatility as a byproduct of that because there's more price impact on those large buys or sells in the market.
So let's talk about kind of the network usage itself. Obviously, the big story in Q2 was ordinals and inscriptions. It just exploded in terms of popularity. What do you see there?
Yeah, so it's kind of funny. It doesn't even feel like that was last quarter with all the regulatory stuff that took place, and then all the ETF news towards the back half of the quarter. But ordinals really blew up at the beginning of April. They passed 10 million inscriptions in early April, reached as high as 14.7 million now. And also now they've generated a whopping $56 million in fees for the network, which is a very relevant amount. It's not a trivial amount for the network. So it's a very positive thing for miners, of course, because it's bringing them in more revenue. But we have since seen that of course, the cumulative value continue to rise, but the number of daily inscriptions has continued to drop off. And then as a byproduct of this, we've seen transaction fees come down. So amidst all the interest around ordinals, we saw an explosion of transaction fees reach the highest level that they had been since early 2021 during kind of the speculative mania of the peak of the bull market in early 2021. But since we've seen transaction fees revert back down to essentially the levels that they were before kind of the big speculative mania around ordinals in April.
And so when you see these transaction fees, that big spike, and then they kind of come back down, is the expectation that they should kind of return back to that normal state and stay quite low, especially with things like Lightning Network, et cetera, taking a lot of the pressure off. So even if we enter into another bull market, fees shouldn't really spike as they had maybe in the 2017 bull market?
Yeah, I mean, to your point, I think ordinals were, a kind of good wake-up call for a lot of people, and that Bitcoin could use some type of layer 2 scaling solution. Maybe it's Lightning, maybe it's something else that doesn't even exist yet. But if we see that type of behavior return where the mempool is super backed up, it costs a ton to get people to be able to transact on the network, it could be beneficial to have some type of scaling solution like a L2 that we could move a lot of that kind of smaller transactional activity to, so that people are able to transact without having to pay a ton of fees.
Now, let's talk about the number of Bitcoin wallet addresses on chain with at least one Bitcoin. We now crossed over 1 million, I believe.
Yeah, this is kind of a just fun stat that I decided to throw in. If we look at the number of addresses that have at least one Bitcoin this quarter or last quarter, that crossed 1 million. So there's now 1 million whole coiners on the Bitcoin network. What does this illustrate? It illustrates that larger market participants are losing market share to the smaller guys that continue to accumulate. When we look at the amount of BTC held by on-chain entities with less than 10 BTC relative to overall circulating supply, we can also see that they're continuing to take up a larger portion of supply. Therefore, Bitcoin's supply distribution is continuing to improve over time.
Now, one of the things that people always talk about is, Bitcoin isn't scalable. Look at how much Visa or MasterCard can settle. In Q2, Bitcoin's network settled $2 trillion of transaction volume. That's a big number. That's an $8 trillion kind of annualized number. And we're doing that in a bear market. That's pretty impressive.
Yeah, absolutely. It's insane. And when we look at that from kind of a cumulative perspective, Bitcoin's now settled 858 million transactions for a total cumulative value of $109 trillion. So, for a decentralized network that's completely uncoordinated, in 14 years, it's a pretty remarkable feat.
Talk about hash rate. That just seems to grow up and to the right and it never stops. Like, what is going on there?
Yeah, I'd been posting almost every week, Bitcoin hash rate all-time high. And then I ended up just feeling I was being redundant by continuing to post the same chart every single week, which is a good problem to be having because it's showing that the Bitcoin network is continuing to become more and more secure. That's a reflection of two things. A, individuals that are already mining, purchasing more efficient machines, they're able to generate more hash rate for less energy. And then second, more miners that are continuing to find interest in and maybe have cheap access to power or whatever it may be that have an economic benefit to begin mining.
So let's talk about the market structure now. Bitcoin's free float, which is the amount of Bitcoin that is not held by the long-term holders, seems to be near an all-time low. Is that a positive thing?
Yeah. So essentially, what we're looking at here is Bitcoin's long-term holder supply, or the amount of supply held by long-term holders. The way we're defining that is by looking at on-chain entities that have held their coins for at least 155 days. If you divide that by 30, you get about 5 months. And so the reason why this kind of threshold was chosen is not just some arbitrary number. Glassnode basically ran some statistical studies and found that past that 5-month threshold, the likelihood of coins being spent back out of wallets drops off dramatically. And so when we look at the percentage of long-term holders supply that makes up of the overall circulating supply, we can look at the inverse of that. So the amount of supply that isn't held by long-term holders, and we have what's here on the screen. And so in purple, it's showing you the amount of supply that's not held by long-term holders. And so therefore, we can see that that's nearing all-time lows, as the inverse of that, which is the amount of supply held by long-term holders, is nearing all-time highs. And so what does this mean? It means that the amount of Bitcoin that are for sale right now is near an all-time low. And so, of course, that will change as we get higher prices. Higher prices incentivize new sellers into the market. But I think it's pretty safe to say that the amount of supply that's been held over the last 2 years, throughout all the kind of craziness in the crypto space, it doesn't appear that these entities that are holding these coins are going to be selling anytime soon without significantly higher prices.
Let's talk about realized cap, both in terms of just the aggregate number, but also the 90-day change you included in the report. What is that?
Realized cap was created by Nick Carter back in 2018 and essentially looks at the market capitalization of Bitcoin, but based on the price that coins were last moved, as opposed to just basically taking the current marginal trading price and multiplying it by circulating supply. And so what realized cap serves as is essentially looking at the aggregate amount of value that's stored in the network. So when realized cap is increasing, it's showing you that there's capital inflows. When realized cap is decreasing, it's showing that there's capital outflows. And when we're looking at this 90-day change, we can get a more granular view of that. We can see that over the last quarter, we've added roughly $14 billion to market cap, so $13.7 billion to market cap, which is showing you that we have started to see capital inflows again for the first time since kind of early 2021 into the Bitcoin network. And then on the next chart that we have, we're looking at realized cap relative to market cap. So what's the aggregated cost basis of the network relative to kind of the current marginal trading price, with the idea that you want to be buying whenever the kind of current marginal trading price is below the cost basis of the network, because everyone's underwater by definition. You want to buy when people are capitulating or under pressure to be forced sellers. And then on the inverse of that, in the bull market, you want to be buying when the current marginal trading price has deviated far from the current trading price. Why is that? Because people are very incentivized to sell if they're up multiples over on their trade or investment. And so what we're looking at here is essentially that ratio plotted out with kind of this undervalued zone shown on the bottom in green and this kind of overvalued zone highlighted there in red to show kind of the speculative euphoria behavior that we see at the peak of the bull market. We just kind of pushed out of that zone of quote unquote deep value and are now kind of showing a similar signature in the data relative to other kind of the early innings of prior Bitcoin bull markets.
So if Bitcoin is leaving that area of kind of deep value, if you will, does that mean that we now are officially bottomed? We're in a bull market and like kind of kicking off that whole process again?
Sure. I mean, it's always tricky, like calling bottoms for sure. I kind of lean on a realm of probabilities. I would say yes, with the caveat that, like, of course, we could retest the lows. Something takes place like March of 2020. But I think at this point we've kind of moved out of that area of deep value and accumulation. And I think just the sheer amount of forced selling that took place at the end of 22, I think would be pretty difficult to replicate.
Awesome. If you enjoyed this, make sure that you go check out Reflexivity Research. You can just go to reflexivityresearch.com or you can click on the link down below. Also, we are helping somebody who is building a brand new data product. It's been fantastic. It's called Velo, V-E-L-O. You can go to velowaitlist.com, sign up for the waitlist. They're letting a couple of people off every single day and get onto that product. See you guys next Saturday.